Hey, welcome to Mortgage Minute for the end of February. Well, the headlines are dominated by talk about two things. Number one, the price of oil, the ongoing, here's one that says the Alberta oil squeeze. This is basically talking about the fact that people in the oil industry, of course we know the big players are going to be impacted, but what about everybody who supplies and makes their living off supplying the oil industry? That's going to be the next victim of the decline in oil prices. However, that is a geopolitical issue, and we expect that to correct itself. The bigger conversation that's taking place right now is interest rates. Interest rates has been a topic for a long time, but one particular part about interest rates right now, because of course, as we all know, March 2nd is the RSP deadline. So one of the big questions now is, should I put, if I have excess money, does it make more sense to invest in my RSP or invest in anything, or should I pay down my mortgage? Now, of course, first and foremost, that's a personal question, and each and every one of you who are asking that should sit down and have a consultation before, I can't give all of you an answer in this video, but Rob Carrick wrote a great article on debt versus RSP. Now, traditionally, there has been a school of thought that says, no, you take care of your debts first, and then when you have extra money, you should start investing. However, the way interest rates are right now, it makes a very interesting dilemma, a very interesting conversation, because on one hand, you could see your interest rate on a mortgage today be below 3%. Well, it is below 3%, or should be. I mean, we're seeing fixed rates at 2.79, 2.69. You're seeing variable rates as low as 2.15. We may see the variable rates drop further if on March 4th the Bank of Canada makes a rate announcement that they're going to cut rates even further. Then the variable rate mortgages will be below 2%. Well, if you're paying down, if you have excess money and you're paying off your mortgage, it's the equivalent of getting a 2% return on your money. Now, alternatively, if you can get an investment that gives you anything north of 3%, you theoretically should be putting your money into the investment, making a profit there, and then down the road, as that money builds up, you can take a lump sum and pay off the mortgage in the future. Two schools of thought, but if you're curious as to what you should do, please give me a call and book a consultation. We can have that conversation, talk about safe, secure alternatives to investing or paying down debt. Now, talking about interest rates, this is really important. March 4th is the next Bank of Canada rate announcement. You may have heard an article I wrote, interview I did last week. I suggested that we could see variable rates as low as 1.9%. That's assuming the Bank of Canada decides to drop rates again. Well, guess what? Stephen Pullis came out yesterday and said, no, not likely. Pullis signals rate cut not imminent. What's happening is the Americans got a little angry at Canada and other countries for lowering their interest rates, and money started flooding into the U.S. dollar. And behind the scenes, you heard a little rattling and arguing about, well, you know, Canada, why are you lowering your interest rates? Well, I think Pullis is now coming up with comments like, well, given what we now know, we think it was an appropriate amount of insurance. He said originally that the reason they were lowering the rate was to provide a bit of an insurance factor. Well, bottom line is, I think the Americans have said, don't get too aggressive on lowering your rates, because that will cause more money going into the U.S. dollar, and the U.S. dollar is going up like this. I don't think it can be substantiated. So I think we're going to see a prolonged period of low interest rates. We might not see a further rate cut, but definitely it's not going up anytime soon. So you're now in a position with this historically low rates. It makes variable rate mortgages very attractive. However, I'm going to be suggesting to my clients, you might want to take a variable rate today, but be very careful, because when the U.S. dollar gets to a certain point and they find out that it's not substantiated by the economy to support that, you could see a collapse in that. I expect that 18 months, 24 months from now, and that would be the time we'll start seeing rates rise in Canada, and that would be the time to move from variable back into fixed. Sounds confusing, I know. That's why book a consultation. That's all I can suggest. Every one of your situations is unique and it's personal. So let's have a consultation and discuss that. But there's lots going on, and now's the time to take action and take advantage of this historic time of low interest rates. Hope you have a great week, and that's your Mortgage Minute for today. Thanks very much.